ladies and gentlemen. This is our financial show, Modern Financing with Sasha, at POT TV. And I would like to introduce our regular contributor, Dr. Milan Sambrak. Welcome to the show. How are you today?
Thank you. Great to be here. Thank you for inviting me.
Yeah,
How
it's
am I today? I haven't made any major mistakes yet today, so I'm still all right. But the day just beginning, so lots of time for major mistakes.
it's not just beginning. It's less than 3 hours left for trading today. So
Oh,
if you want to make some money, it's about time to do so.
yeah.
The only thing is, we don't know which way a market will turn. Actually, it's very indecisive today. It's kind of neither here nor there. It's basically a trading day. So you may want to, what I did today so far, adjusted my trading positions on options on my great trading fund account. Again, my core account is untouchable. Don't
Good.
touch it. Don't even look at it. Sometimes maybe once a month uh, I can look at prices. But on the fund account, actually I initiated some very interesting position. Remember, you missed a couple of programs, so you didn't know what I did.
I saw it.
Actually,
I saw the program. Yes,
oh,
thank
you
you.
saw the program, yeah. So AMG trade was fabulous. It did very well for me. And also on Monday, believe it or not, I initiated a large position in the March calls on Alibaba. And guess what? The next day, stock jumped to $9, and my calls went into stratosphere. So, but I didn't close position. I sold a close by call, say by December 16th, if I remember correctly, at it's the same price. So I'm getting a lot of premium now from this December position, which covers all my March long calls. And once they will expire, if they will not expire, I will just roll them over. But the only thing is, if they will go into stratosphere, then my March calls will also go into stratosphere, even more so because there is more time left. So I enjoy my position tremendously, and I'm looking at it every 15 minutes or so just to enjoy myself. Uh, how you're faring these days?
Well, will you allow me to make a few philosophical statements?
Absolutely,
First,
absolutely.
first of all, James pointed out, I think, a couple of weeks ago that a lot of people don't understand derivatives.
Hmm.
So there's this book that people can buy for $300 US, and they can study it, take a year to study it. At the end of that year, they will not be any further ahead than simply holding the S&P 500, simply holding an exchange-traded fund which tracks the S&P 500, such as SPY, for example. So now, the philosophy that I'd like to talk about today is deals with rules-based versus judgment-based activities in the stock market. Rules-based activities always work. As an example, the money which we will need in the next 2 or 3 years does not belong in the stock market. That's a rules-based, which works all the time. Wall Street doesn't get much out of the money that we don't have in the market, so this is a part of the conflict of interest that Wall Street has with us. So that's a rule. We talk about 6 rules frequently, which always result in a positive return. I'll mention that in a minute. And the 6th rule is number 1, save. If you don't save, the other 5 don't count. Number 2, do it yourself, rules based. Number 3, buy the American market as a whole by buying an exchange traded fund which tracks the S&P 500. The rule number 4 is buy and hold, don't trade. Rule number 5 is adjust to your asset allocation, be it 50-50, 60-40, 55-45, doesn't matter. Time in the market matters. Adjust to that anytime that market movement throws it off. And rule number 6 is avoid complexity. If you have an investment that you cannot explain to a 12-year-old, don't get into it. Those are all rules. And those rules result in a return and you and I have a slight difference of opinion of that here. They result in a return of, I think this is visible, of um, 6.5% annually, inflation adjusted, over the last more than 100 years. Actually, it's closer to 200 years that the American market has returned that with enormous fluctuations. The fluctuations vary enormously. That's why the money that we're going to need in the next few years does not belong in the market. So those are rule-based activities that always work. Now, at the other end, we have judgment-based activities, which is picking stocks. And when you're picking stocks, both parties cannot be right. The seller is right or the buyer is right. Both cannot be right, except in some very rare circumstances, which we don't need to get into. So we need to base our activities as much as possible on rules rather than on judgment. So let's take a look at an individual stock, Facebook, recently. When Facebook went public in 2012, it earned $3.7 billion, yet it fell 50% in that year. From then on until August of last year, Facebook went up 2,000%. That's unmatched, unbelievable. In the space of 9 years, it went up 2,000%. Now, the stock now is down almost 75% from its all-time highs, falling more than 20% just last Thursday alone. So last fall, Facebook had a market cap of over $1 trillion. It now has a market cap of 265 billion. That is, it's lost more than $800 billion in a little over a year. 800 billion. There are only Apple, Microsoft, Google, and Amazon have a market cap of 800 billion. There isn't a single other stock on the S&P 500 on the New York Stock Exchange that is that large. Do you really need to get involved in something like Facebook
You don't even have to love music.
and other stocks which have similar stories? So this is the argument in favor of rules-based investing and avoiding judgment-based investing as much as possible, although it's not always possible. We have to have some judgment. But that will yield 6.5% inflation adjusted, or it has yielded in the past. And, Confucius said, study the past if you will understand the future. It has yielded 6.5% over 100 years investing in the American economy. And likely in the next while, the American economy is going to be stronger than the Albanian economy, let's say. So that's the place to be. And it was no thinking, no judgment, very little time. It can be taught to an 18-year-old student. And that's the idea that we promote. It isn't much fun, it's boring. Investing needs to be boring. Like Paul Samuelson said, it should be like watching grass grow or watching paint dry.
Okay, it's a very interesting concept, and that I'm a big fan of that approach. Um, what I can say is that it cannot you cannot find a recipe that would be agreeable to all people. It is good
Absolutely.
for some
You're
people.
right. You're
It
right. You're right.
may not be so good for other people.
You
It
have to
also
have a
depends
difference of
on
opinion. Yeah. If you don't have a difference
absolutely.
of opinion, you don't have a market. You need a difference of opinion.
Absolutely. So, as a philosophy of this type of investing, I think it's a very, very viable for people, of course, close to retirement or in retirement already, where preservation of capital is not even paramount, it's the only consideration. And all you're trying to do is at least be in step with inflation so your assets will not start deteriorating, and your essential, say, $1 million in 5 to 10 years, all of a sudden their buying power will be equal only to $800,000, and so you're trying to be in step with inflation. And probably you can do that. Now, if you're talking about not 12 years old, but let's say 20 years old, 25 years old, this system of investing is absolutely prohibitively unsustainable for them, because their aim is not preservation of whatever little capital they most of them have at that age. They have to be aggressively investing, trying to maximize return. It involves, of course, more risk, but sometimes they will be rewarded. So if you systematically invest, say, $10,000 in riskier assets than S&P, obviously there is more risk. What kind of risk? It's up to your judgment, really. But once you, at least a couple of times, you will hit the stride through your research, through maybe even luck, through understanding the companies that you're investing and so on. I must tell you, I've investing in stock NVIDIA. I invested 10 years ago when it was only $12 a stock. It was $12, and I had stock, and I was selling covered calls at that time. So it's a different company at that time, different scale from what it is today. But it means that I'm following certain company for 10 years and longer than that. So I know how they trade. I know what they do in the morning. I know what they do in the afternoon and the closing hours every day. I have a feel of the volume or so on. And of course, people who are not going to do that work, they will not be able to have any rewards. I can assure you of that. So they might as well stick to your system of buying S&P 500 and sit there and sit and wait and hope for the best, and sometimes reallocate the cash into your stock position and back selling some stock position, allocating it back to cash. And so this is a good model for people who know very little about the market. You are right. You are saying that you have to be able to explain your strategy to 12 years old. So this strategy is absolutely geared to 12 years old, except that they're older than 12 years old, most of them, and they have way much more assets to worry about than 12 years old. Otherwise, there's not much difference, right?
Um, it's as close to a guaranteed 6.5% return annualized as possible. Guaranteed. When you buy Nvidia or anything else, you're buying from somebody who's selling it. You can't both be right. When you sell something, you're
Strongly
selling it to
disagree
somebody
with
who's
you.
buying it.
Very strongly disagree with you. I'll tell you, first of all, I'll tell you a scenario, and there are many, but at least one when both are right. And I'll tell you how. Let's say somebody sells you a stock, just any stock at $50 a share. So you're buying at 50, he's selling at 50. So
Right.
in your theory is that one is right. Why? Because if stock moves down, then he, the seller, is right, and you, the buyer, is wrong. But let's
Most of
see
the time,
when
not all the time, most of the time. Yeah, okay, continue, please.
I'm not so sure. Even most of us, I don't. I'm not even thinking that even at any time it's valid. I'll tell you why. Let's see, you bought stock at 50. It went down to 48 for various reasons. The next 2 3 days, it went back to 50. It went back up to $55 in next month or so, due to various reasons. Maybe they had a good earnings report. Maybe it's a seasonal factor, a Christmas rally, a New Year's rally, whatever. So it went up to 55. Now, who is right and who is wrong? At the beginning, he was right, the seller, you were wrong, the buyer. But a few days later, all of a sudden, he is wrong. He sold stock at 50, which is now 55, and you were right. You bought at 50, went down to 40,
Yeah.
and went up to 55.
Let
How
me
you play that?
let me ask you, Sasha, how important is it to think long term versus short term? You're talking here about day trading, actively being involved, whereas what I'm talking about is as close to guaranteed. And Paul Samuelson's statement that investing should be like watching grass grow or watching paint dry applies here.
Milan, I totally agree with you. We're talking about two different animals. As I admitted myself, I have a portfolio with high yield dividend stocks, which I
Okay.
don't trade, don't sell options, don't have a margin, absolutely none of that. So this is something stashed away. I don't manage it, and
Good. Yeah.
that's
Yeah.
it.
I agree
And
with
I'm
that.
collecting dividends, and I did some. Okay, one of the stocks is paying dividends every month. I love that stock because of monthly payments.
Yeah.
Other stocks are paying once every 3 months. So
Yeah.
one is paying in March, another one is paying in April, another one is paying in June, and so on. So that I don't touch. I'm not talking about investment where I tend to believe that the high yield dividend stocks performing better than the market overall, especially in downturns. They're fairly safe because the whole market is going down 25%. The high yield paying dividend stocks are going down 5%
Let
only.
me ask you, Sasha, what percentage of your overall market investments uh, are these high dividend stocks? What
I
percent?
would say close to 80%.
80%. That's great. That's great. Yeah,
Yeah, and 20% I have actively trading account.
that's great. Now, you've heard of the dividend aristocrats.
Yes,
These
of
are,
course. Yeah.
these are stocks that you're talking about here, and stocks which have paid an increasing dividend every year for more than 20 years. Those stocks qualify as dividend
Yeah,
aristocrats. Coca-Cola, for example.
sure.
So now, of the 5,000 or so securities that are traded on the New York Stock Exchange, about 60 qualify as dividend aristocrats. And there are exchange traded funds which are entirely made up of dividend aristocrats, and they trail the S&P 500. That is, if you buy an exchange traded fund which tracks the S&P 500, an example would be SPY. It is one of the few exchange traded funds which tracks the S&P 500. There are now more exchange traded funds than their individual securities, but only about half a dozen of them apply to the philosophy that we're talking about here. They track the U.S. market as a whole, and so exchange traded funds tracking the U.S. market as a whole have outperformed the dividend aristocrats. There are exchange traded funds entirely made up of dividend aristocrats. And think about it, it's very impressive that a company has paid out increasing dividend every year for more than 20 years. That's impressive, but hasn't done as well as holding the S&P 500. But it does produce income. You know, I'm a retired dentist, and I've had patients who had nothing but dividend aristocrats, old ladies, widows, and orphans, people who were not interested in the market. They were interested in getting a paycheck every month or every 3 months. They never looked at the market. They just cashed in the checks, and that works. Not as well, though. So it takes very little effort to follow the philosophy that I'm describing. The philosophy that you're describing, Sasha, requires daily input of effort. And some people enjoy that. I would say many people enjoy that. And certainly Wall Street encourages that. Wall Street gets nothing if you have an asset allocation where you have, let's say, 50% in the market and 50% in cash, 60-40, 55-40, doesn't matter. You have a significant part of your investments in cash. What does Wall Street get out of that? Nothing. So they encourage you at every turn possible to trade actively, to get involved with the initial public offerings, to day trade, to buy penny stocks and that kind of stuff, which is really contrary to your economic well-being.
Well, may I ask you a question? This so-called ETF dealing with dividend aristocrats, what on average their return as dividends? What is their average return? Just
Oh,
ballpark
you
figure.
know, Sasha, I'm guessing, but it would be somewhere between 3 and 5%.
Right. So if I'm buying individually stock like British American Tobacco, which is paying 7.5%
Yeah, yeah,
annually,
right. Yeah, yeah.
and I collect check every. Actually, I don't collect. I keep it on the account for reinvestment purposes. But let's see, it's worth 3.5. Sorry, 3.5% versus 7.5%.
All right.
Why would I buy this ETF dividends aristocrats?
You're right. You're right. Now you're talking about American tobacco.
British American Tobacco. It's trading on U.S. exchange as well. It's
Yeah,
trading
a lot
on.
of people have trouble buying tobacco and buying other what do they call them industries that are based on evil assumptions that are based on addictive properties that they have for their clients. A lot of people.
Well, yeah. So all the spirits stocks, so are the marijuana stocks, and there are a lot of stocks which are in this area. But another example, I'll give you Altria Group, which is paying
Right.
8.5%
Yeah.
dividends, and I'm not considering them being dividend aristocrats, but for time being, I love their performance and what they're paying. Another
Well,
one is which is paying actually monthly dividends I mentioned before. It's Gabelli Income and Dividends Fund. The Gabelli is well-known U.S. money manager. Is doing extremely well, and that stock is
that's
uh,
true.
it's a ETF. Well, in a way, it's ETF. It's not real ETF, but it's one of these privately held funds. But it's tradable. It's
Yeah.
trading on the
So
exchange.
let me ask you, Sasha, uh, how much time do you spend on investing on the market?
Oh, I spent, let's see, minimum 15 minutes a day. Sometimes I spent an hour a day. But every day I'm monitoring my trading portfolio and I'm doing adjustments, depends which way market
Now, we
performs.
did a survey of our members. You know, Monday Morning Millionaire people are largely professional people of all ages, mainly dentists and physicians, nurses, veterinarians, optometrists, and some other business people. And we did a survey to ask them how much time they spend on investments. And it's more like 15 minutes a month or a quarter or annually to get the results that I'm describing. Now, you can get better results than that, possibly, but not certainly, not even likely, because the program called SPIVA, SPIVA, which stands for S&P 500 versus active investing, shows that over a market cycle, which is peak to trough to peak, the vast majority of investors, including professional investors, cannot match the simple act of holding the S&P 500. So if you want to beat that, yes, you have to deviate from some of these 6 rules that I just described. That's about the only way to do it. But you stand a very good chance of not doing well. You know, you described some securities that you held in which you did well, but I bet you can describe securities which didn't do very well at all. Taleb's turkey kind of securities. You know, a turkey that's fed every day begins to believe that it's the law of life to be fed every day. Then the day before Thanksgiving, suddenly things change and the turkey is toast, gone. How many securities have this Taleb's turkey type of chart where they keep rising and then suddenly they tank? And
There were cases where I was hurt and hurt badly. One case was with a Boeing, which I had shares and I sold covered calls, and they were paying dividends at the time. It was right before the COVID. And right before the COVID, I was on a cruise for almost 3 weeks in Latin America. And I returned on March 2nd. And in 2 3 days, there was already announcement of pandemic, and there was a huge market drop in about a week time or so on. And in during that time, I didn't follow the market at all, and I lost a touch with the market. I started to be a little bit disoriented. So maybe there are some different people that they may look at the market maybe once every 10 years or so, and that's more than enough. But there are some people that, like myself, I know that they have to be actively be in touch with the market. They have to feel which way market is reacting. I'm looking at stocks that I'm following really on a daily basis, and I see the volume of buying into that stock, and I know that institutions are behind that, and the stock is ready to move. You see, when you're talking about long-term investing versus short-term profits
Yeah, that's right. Yeah.
trading, uh, if you cannot make profits in the short term, how you can make profits in the long term? So in the short term, you have loss after loss after loss, and one more loss. Then how can you demonstrate
So
winnings?
you only have loss after loss after loss if you're buying individual securities. And
But if
already,
you're buying S&P 500, what's the difference?
oh, the S&P 500. Let me ask you this, Sasha. Where will the S&P 500 be 20 years from now? Will it be higher than it is today?
Yes, most
Yes.
certainly, yes.
What about 10 years from now?
I would say so, yeah.
And probably five. So in the long term, now we are not long term, we are short term, but we need to think of our estate too, because our estate should outlast us, and our estate ought to be planned in a long term perspective. So you know the American economy, which has been the best performing economy in history for over 100 years, actually close to 200 years, is likely to continue that way. Now, empires all have a 100% failure rate. The 15th century belonged to Portugal. The 16th century belonged to Spain. The 17th century belonged to Holland.
Hmm.
The 18th century belonged to France. The 19th century belonged to Great Britain. The 20th century belonged to the United States. And the 21st century, will it continue to belong to the United States? China is looking very threatening, although you cannot trust their numbers. The Economist, the publication Economist itself, stated that you cannot trust the figures that come out of China. But yeah, empires have a 100% failure rate. And someday the American economy will fail. And the approach that we use by the American economy as a whole will not work anymore. We don't see any evidence of that. Everybody wants to be in the US dollar. The whole world wants to be in the US dollar. The US dollar now is equal, if not more valuable than the euro or than the British pound. It was about half of that 15 or 20 years ago. So the place to be, the trend is your friend until it isn't. So a trend is much more likely to continue than it is to reverse itself. But someday it will reverse itself. And when will that day come? We don't know, except with hindsight. So you were talking recently, Sasha, about buying more of a security that is rising. And that is that's momentum investing. And momentum investing, you can go to Social Sciences Research Network, SSRN, which is an academic publication where they have no interest in your or my trading. All they have an interest in is to get published, because they live in a publish or perish world. And these are academic perspectives, not related to your and my active investing. You can go and check momentum investing over there. Then it's a valid approach, but it needs constant monitoring. And a lot of people enjoy that, and they should be doing it then, because as you said, you need to have differences of opinion, otherwise you haven't got a market. So
But you see, Milan, I would like to mention before the end of today's program, I would like to mention that I'm not suggesting that all people have to do is momentum investing, period. Even I'm not doing that. I enjoy it, but I don't do that because, as I said, well over 75, close to 80% of my investment is in high yield dividend stocks, which are bringing fabulous dividends year after year, and I don't touch it. Now, my 20 some percent, I'm actively involved in managing this 20%. And trust me, if I would keep losing money, I would probably stop doing that, because you don't enjoy doing something that doesn't work for various
of
reasons.
course, of course,
So
yeah.
And what I'm saying is that every individual, if he's inclined to do so, if he has more valuable things to do, let them do it. I'm not urging everybody get to their computer screen and start watching the stock for 15, 20, or even an hour a day. No, not at all, unless they enjoy it. Now, if you enjoy it, then you must learn at least a thing or two, and I can help to do that if you're open to that. If you're not open to that, say, no, 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 no. I want to buy only S&P 500 or so on. So you want 100% of your portfolio be in S&P, and that's fine. I don't see anything wrong because
Well,
people do.
we talk about having a fund portfolio for those who need it, who enjoy what you're talking about, and many
Yeah,
people do, and they should do it. And so,
very
a
good.
fund portfolio, but a fund portfolio should be of a size which allows you to continue living the way you live if you lose it all.
Absolutely agree with you. No, thank you so much for your contribution, and we'll continue our conversation next Wednesday. Thank you so much, everybody. Bye bye.
Thank you.